Adam, I often refer to cash because you say you don't see the pain. I kind of refer to it as the carbon monoxide of the investments. It's a safe way to go broke. You feel good. The value is staying the same, so you feel safe. But every single day, it's buying less milk, less fuel, less food, less medicine, less everything. And so, carbon monoxide. Avoid.
Well, that's a good point too, because you mentioned inflation and how high it's been, but even historically, around that 2 to 3%, your cash is always essentially going backwards as far as your purchasing power goes in most market situations.
Yeah, so dollar-denominated assets, income seekers, fixed-rate mortgages, fixed-rate borrowers, all benefit a little bit from inflation. Obvious losers from inflation.
Cash. I mean, that's one of the conversations we had with clients this year when we're talking about, like I mentioned, with the balanced portfolios and the downward trend we've seen in fixed income this year. It's well, maybe I should just go to cash. And well, obviously we've talked about that a little bit last time about, kind of selling at the bottom and not getting back in. But the other side of it is those people that have held cash, your purchasing power is down 8% this year too. So that's an area where cash, when inflation goes up, costs you more money to buy the same goods essentially. So.
And I think that's the hardest thing about cash. It's one of those things that obviously, you hear cash is king and, cash buys everything, but it also stays, from a visual standpoint, it stays stable. You have $100,000 in the bank, it's still $100,000 plus your tiny bit of interest. You don't see that erosion. You get mad about gas at the pump and you get mad about food prices, but you don't see how that's affecting the value of your cash.
Adam, I often refer to cash because you say you don't see the pain. I kind of refer to it as the carbon monoxide of the investments. It's a safe way to go broke. You feel good. The value is staying the same, so you feel safe. But every single day, it's buying less milk, less fuel, less food, less medicine, less everything. And so, carbon monoxide. Avoid.
Well, that's a good point too, because you mentioned inflation and how high it's been, but even historically, around that 2 to 3%, your cash is always essentially going backwards as far as your purchasing power goes in most market situations.
Yeah, Kyle, the only thing I was going to say is on with consumer price indexes, which is that's really what we measure inflation with, right? The three biggest components to that are real estate, so housing, including rents, which I think a lot of people know rents have been accelerating really quickly the last few years. Food is I guess it's just the third largest, and then transportation is the second largest. So transportation, housing, food and beverages, if you just look at sort of what's happening with interest rates, with the Fed trying to raise rates and hold inflation down, I mean, all three of those things should have some effect just in terms of slowing the growth. And we've already seen housing prices they're not accelerating as fast as they were. People are asking whatever they're asking to sell their house, and they're already having to cut prices over those sort of wished numbers. And so that just tells you, obviously, mortgage rates are up. Demand for housing is going to be down a little bit, versus how fast it's been growing the last few years.
Yeah. So other losers from inflation. I know we talked about the flip side of borrowing. So if you're a future borrower, inflation's pretty painful. I know in the business side, M&A, mergers and acquisitions activity normally dries up quite a bit once rates start going up, because in order to buy a company, they're typically leveraged buyouts. I won't get into all the details there, but the bottom line is they're borrowing money to buy the company. And when rates go up, that gets a lot more expensive. So it typically drives up M&A activity. Other losers? The only other one I can think of is fixed rate investments. I mean, if you took on a fixed annuity, 2 years ago at 2%, that's going to be fairly painful.
Right.
Obviously, luckily we don't have a lot of people in that situation, but just identifying winners and losers from inflation is pretty important.